If you're an LLC owner, you've probably asked yourself a question that sounds simple but has massive financial implications. How do I actually pay myself? Seriously, how do you move money from your business account to your personal account? The way you do this isn't just a transaction, it's a huge strategic decision. You get it right and you're building wealth the smart way. But if you get it wrong, well, you could be handing over thousands of extra dollars to the IRS that you really didn't have to.
So here's the game plan for this explainer. First, we're going to talk about the absolute foundation of any LLC, that financial wall. Then we'll get into the default method for paying yourself, and I'll show you the exact point where that easy method becomes a really bad deal. From there, we'll unlock a powerful strategy for some serious tax savings. And finally, we'll wrap up with the universal rules that keep you protected no matter which path you take. All right, let's start at the beginning. Why did you even create an LLC in the first place? I mean, for most people, it really boils down to one thing: liability protection. But here's the catch. That protection, it isn't automatic. It's something you have to actively build and then constantly maintain. And the very first brick in that wall is separating your business life from your personal life. Now, to pay yourself the right way, you gotta learn to think like the IRS. And in the eyes of the IRS, your LLC is what's known as a pass-through entity. What on earth does that mean? It's actually pretty simple. Your business itself doesn't pay income taxes. Instead, all the profits just pass through directly onto your personal tax return. And you have to understand this concept because it affects every single dollar your business earns. Okay, so here's a perfect picture of that financial wall we've been talking about. See? On one side, you have all your business assets, all neatly tucked away in a business bank account. And on the other side, you've got your personal stuff. The moment you start mixing these, paying for your groceries with a business debit card, you're doing something called commingling funds. And that right there is the fastest way to demolish the very liability protection you set up the LLC to create. So once that wall is up and strong, you're ready to start moving money across it legally. Now, most new LLC owners start with the most straightforward method there is, the owner's draw. It's super easy, it's fast, but, and this is a big but, it has a hidden tax trap that can become incredibly expensive as your business grows. An owner's draw is pretty much exactly what it sounds like. You're not an employee taking home a regular salary. Nope, you are the owner, and you're taking a distribution of the company's profits. You see money piling up in the business account, you need to pay your mortgage, you just transfer it over. It really is the most basic way to pay yourself. But, here's where that whole pass-through thing we talked about comes back to bite you. The IRS doesn't actually care how much money you physically move out of the business account. They tax you on all of the profit. So, let's say your business makes $80,000 in profit, but you only take out $40,000 for yourself. Guess what? You are still paying taxes on the full $80,000. Even the money you leave in the business to grow, that gets taxed too. Okay, this is where it really starts to get interesting. As your business succeeds and grows, the beautiful simplicity of the owner's draw, it actually starts working against you. There's a very real financial tipping point where easy suddenly becomes very, very expensive. So let's figure out exactly where that point is. And here is the culprit, the 15.3% self-employment tax. This little line item covers your contributions to Social Security and Medicare. And when you're using an owner's draw, the IRS sees you as self-employed, so every single dollar of your business's profit gets hit with this 15.3% tax. And that's on top of your regular income taxes. So this begs a really critical question for every successful LLC owner, right? When does that 15.3% tax bill get so painfully large that it's just time for a new plan? At what point is the simplicity of an owner's draw just not worth the cost anymore? Well, according to expert analysis, the magic number seems to be right around $50,000 in annual profit. Once your business starts consistently clearing that threshold, The amount of money you're losing to self-employment tax is more than enough to justify switching to a more advanced tax-saving strategy. So what is this advanced play? It's something called the S Corp election. And let me tell you, this is probably the single most powerful tool a profitable LLC has in its arsenal to dramatically slash its tax bill. I know, it might sound a little intimidating, but the strategy behind it is surprisingly simple and incredibly effective. Okay, check this out. The S Corp election basically lets you wear two different hats. With your employee hat on, you pay yourself a reasonable salary for the actual work you do. And yes, that salary is still subject to those payroll taxes, that 15.3%. But, and here's the magic, with your owner hat on, you can take all the rest of the profits as a distribution. And here's the key. Distributions are not subject to that 15.3% self-employment tax. This is how you start saving some serious money. Let's just break this down side by side. With a default LLC, you take simple draw and 100% of your profit gets smacked with that 15.3% tax. With an S Corp, you take a salary plus distributions. Yeah, it's a little more complex, you have to run payroll, but the payoff is huge. Only your salary gets hit with those payroll taxes. The rest is safe. Let's put some real numbers on this to see the difference. Let's say you have that same $80,000 profit. As a default LLC, your self-employment tax bill is over $12,000. Ouch. But as an S Corp, if you pay yourself a reasonable $50,000 salary, your payroll tax bill drops to just over $7,600. That is almost $5,000 back in your pocket for the year, just for filing a different form with the IRS. That's a game changer. Look, no matter which strategy you end up choosing, the simple draw or the S Corp, some rules are just non-negotiable. These are the fundamental principles that protect your business, your personal assets, and that incredibly important liability shield. You get these wrong, and honestly, everything else we've talked about can fall apart. Think of this as your 4-step protection protocol. Step 1, get an EIN from the IRS. It's like a social security number for your business. Step 2, use that EIN to open a completely separate, dedicated business bank account. Step 3, and this is the big one, never commingle your funds. Ever. Business money pays for business things, personal money pays for personal things. Period. And step 4, have a formal backup plan for when you inevitably mess up. And that backup plan? It's called an accountable plan. It's just a formal process you set up for those times you accidentally swiped your personal card for a business lunch. It lets you properly document that expense and then reimburse yourself from the business, tax-free. It's the right way to fix a common mistake and keep that financial wall standing strong. So the main takeaway here is really clear. How you pay yourself isn't just about moving money around. It's a core financial strategy for your business. So I'm going to leave you with this one question to think about. Is your current payment structure just a simple default, something you haven't really thought about? Or is it a deliberate, strategic tool you're using to be tax efficient and fuel your growth? Are you leaving money on the table, or are you building your wealth as efficiently as you possibly can?